Hey guys, what's up? I'm Erin and welcome back to the channel. We've always heard that the average return of the stock market is about 10%, and over the long term, that's been true. Of course, we all know that that doesn't look like a nice and pretty 10% each year. The ride is anything but smooth. It involves a lot of volatility, up years and down years. But what can we expect going forward? Can we rely on our trusty 10%, or perhaps do we need to adjust that number for our ever-changing and perhaps more tumultuous economy? Well, for that, I think we need to turn to the experts. And when I say experts, I mean the institutions that spend their entire time analyzing our markets. One quick note to make about that 10% rate of return, that is the nominal rate of return, so the rate of return prior to factoring in any inflation. Historically, inflation has hovered around 2 to 3%, so we can say on average, the real rate of return would look something like 7 to 8%. And that is an important distinction to make. Keep in mind that the presented numbers in this video are all going to be nominal rates of return, so presented prior to factoring in inflation. And we all know inflation matters. Disclaimer, we all know we can't predict the future. Of course we can't. But if we can get some rough ranges of numbers that we could potentially expect as rates of returns, maybe we can make better estimates about our future. Maybe we can better figure out how much we should be investing to hopefully hit our target goals. Question for you, what number do you like to use as a rate of return when you're running your estimates about the future? Let me know in the comments. And with that, let's dive into the research. Vanguard, the long-term expected rate of return on US equities is 4.3%. At the very least, if you're comparing a 4% rate of return to the historical average of 10%, you can easily say those numbers are vastly different. If you invested $500 a month for 40 years and captured a return of 4.3%, you would have roughly $670,000. But investing the same amount with a 10% rate of return would net you roughly $3.2 million. Those nest eggs would provide vastly different retirements. In fact, if you wanted to reach $3.2 million in 40 years with a 4.3% rate of return, you would need to invest a little over $28,000 a year. So your rate of return matters big time. Now, in the wake of the pandemic, our economy and the global economy as a whole have had a really rough time rebounding. Inflation has surged to levels we haven't seen in 40 years, and the stock market has had a rough year to say the least. But Vanguard states, investors should not fear a lost decade for US stocks, but rather a lower returning one. So they don't anticipate the future returns to be a total wash, but rather amid all the turbulence, they expect lower returns going forward. And in case you're wondering what a lost decade is, I have a video on it. We have experienced one in the US before, and I will link that video down below. Now, I'm a huge fan of Vanguard, but it's important to note that for years, they have been predicting reduced rates of return going forward in the market. I was able to dig up this market forecast from 2018, where they said they expect the 10-year rate of return to average something like 4.5 to 6.5%. And while the S&P was down 6% in 2018, 2019, 2020, and 2021 posted stellar returns, light years ahead of that suggested rate. And while it's true, we are definitely well within that 10-year time frame. So those numbers could prove to be accurate, or they could prove to be inaccurate. Only time will tell. But I think it's worth pointing out that Vanguard has this tendency to point to lower than average expected rates of return. And there's good reason for that. Expectations. Expectations are everything. So if they suggest that you expect a 4% rate of return, but then you get a 7% rate of return or an 8% rate of return, how do you feel? Great! You were expecting a 4% rate of return. You surpassed it. But if they turn around and say that you should expect a 10% rate of return, but you only get an 8% rate of return, how do you feel? Probably pretty lousy. After all, you were expecting 10. As is the rule in business, under-promise and over-deliver and you will have happy clients. Charles Schwab, expected rate of return on US small cap, 6.8%. US large cap, 6.4%. Again, we see lower future projected rates. The Charles Schwab team does go on to say how they make these future projections. The long-term estimates cover a 10-year time horizon. We take a forward-looking approach to forecasting returns rather than basing our estimates on historical averages. Historical averages are less useful as those only describe past performance. Forward-looking return estimates, however, incorporate expectations for the future. And for this reason, we believe they're more useful for making investment decisions or projecting future performance than using historical results. Importantly, and in light of our current high inflation environment, they add, long-term inflation is still expected to be far lower than its historical average and current readings. That's a common theme I noticed with each of these investment firms, acknowledging that yes, inflation is high today, and it's expected to continue to be high and elevated throughout 2022, but long-term, it is expected to revert to lower levels. Schwab says that the lower forecasted rates are based on three things: low interest rates, low economic growth, and equity valuations. Yes, interest rates are on the rise, but historically they're still considered to be at pretty low levels. If we go back to the 2000s, 6 and 7% rates, that was the norm. If we go back to the 90s, 8 and 9% rates were considered great. In the 80s, rates were easily double digits. In recent history, we've had very low rates. 2 and 3% interest rates are not the norm if we look back historically. As for low economic growth, a robust economy is fundamental to achieving healthy returns from the financial markets. Everything from monetary policy to interest rates and company earnings are linked to this. Our markets reflect the overall health of the economy, and as of right now, our economy faces a number of obstacles: high inflation, a shortage of workers, stagnant pay, and poor consumer sentiment, just to name a few. Further, we have a stock market that's been booming for over a decade. And the argument against equity valuations is that these stock prices have risen to levels not justified by the future earnings of the businesses they actually represent. Long term, the stock price represents the business's performance and projected performance. If stock prices rose too high too fast, now we have to anticipate slower growth until the businesses can justify these higher prices. Social Security Administration. Expected rate of return, less than 7%. Now hold up, I know what you're thinking. Why does the Social Security Administration matter here? Well, when analyzing Social Security reform, the Office of the Chief Actuary actually uses an assumed rate of return on the stock market, and that traditionally has been 7%. Critics argue that the 7% projected stock returns are too high. They base their arguments on recent developments in the capital market, current high value of the stock market, and expectation of slower economic growth. And while they don't cite a new figure to use, the argument is that 7% is simply too aggressive and it needs to be adjusted downward in order to be more accurate. And I do want to make a quick note here just for clarification. Social Security dollars are not in any way invested in the stock market. Social Security trusts are 100% invested in US Treasury securities. JP Morgan expected rate of return for the next 10 to 15 years, 4.1% for US large cap and 4.8% for US small cap. We acknowledge that the end game is uncertain, but a bad outcome is not inevitable. Our long-term capital market assumptions represent our central expectation to what will happen over our 10 to 15-year forecast horizon, while also noting that medium-term risk has risen. They say long-term, they expect the rate of inflation to return to about 2%, so that's looking more like a real rate of return of 2 to 3%, which is pretty dismal. And also the JP Morgan team cites many of the factors that Charles Schwab and Vanguard did as to why their future projections are lower. Morningstar Investment Management expects a 6% rate of return on US equities. It's worth mentioning that in December of 2021, Morningstar had actually given a 10-year average annual return forecast of 1.6%. So this highlights an important point. These forecasters are human. These projections are best estimates at the time, and they are subject to change. The economy is very complex with lots of moving parts, and nothing happens in a vacuum, and it's highly unlikely that any of these projections are going to be 100% accurate. Finally, Research Affiliates, which is a company that helps to gather insights to help firms make better asset allocations and works behind the scenes with financial institutions managing mutual funds, ETFs, and other account types. They have this cool interactive graph that is updated monthly that plots the expected 10-year rate of return and volatility of different asset classes. I'll put a link to it down below in the description box if you are interested. Please note that this chart is presented in real terms, not nominal terms, as the other figures in this video are presented in nominal terms. Here you can see they forecast only a 1.9% real rate of return on large cap stocks and a 5.1% rate of return on small cap and a negative 2.2% rate of return on cash. They do also show that by using an all-equity model, large, mid, and small cap equities, you can perhaps achieve even greater returns of 5.9%. Thus far, every market forecaster is predicting rates of return far less than our often cited 10%. But here's my thoughts on future forecasted rates of return as someone who loves reading about all things personal finance and investing and then turning around making videos about it here on YouTube. I think a 10% rate of return is pretty darn optimistic. It's not the rate of return that I bank on, but I'm thrilled if I get it. I think as a country matures, it's natural to expect that their growth might slow a little bit. But I also think that there's no way that our companies are done innovating and creating value, and for that reason, I like to use an 8% rate of return when I do estimates. But I also think, and I know I mentioned this before in the video, I think there's a huge incentive for these firms to give lower future projections because they have customers to answer to. If you set the bar too high, say the expectation at 10%, but then customers really get an 8%, you're gonna have a whole slew of unhappy customers. Why not set the bar low with the expectation of surpassing it and then have happy customers? If Vanguard tells me to expect a 4% long-term rate of return, but then I turn around and get an 8% rate of return, as a customer, I'm thrilled. They've surpassed expectations. I've held on to this theory for a little while, but now I think I have a little something extra to back it up. While reading the book More Straight Talk on Investing by a former CEO of Vanguard, he presented this table, citing Vanguard as the source, saying that 10% is a reasonable expected rate of return, and 6% is conservative. He also states that over the very long term, it is reasonable to expect similar returns. And while Brennan was CEO until 2008, he still serves as a senior advisor at Vanguard. And this book was just published in 2021, so the information isn't all that dated. And further in the book, Brennan states, during the prolonged 1982 to 2000 boom in the stock market, people began to think that a permanent change had occurred in the economy and that long-term returns going forward would be much better than ever before in the past. By 1990, the 10-year average rate of return in the stock market was 14%. At Vanguard, we wanted to discourage investors from using past short-term performance as a baseline and being unrealistically optimistic about future stock returns. In our client communications, we began discussing long-term investment performance in terms of 15-year returns, which were lower than the 10-year return. Frustrated shareholders wrote to us, "Now you're changing the rules of the game and you're telling me that long-term is 15 years, not 10 years?" That's a fair observation, of course, but we were merely trying to provide perspective that most investors didn't have on their own. So thinking that these companies are trying to temper expectations of their clients isn't unrealistic. The bottom line is investing is done over a lifetime. A single 10-year interval is probably not going to be enough. When making your estimates, it's probably best and safest to use a conservative number, because if you surpass expectations, well, then you just ended up with a larger nest egg. There's far more danger in being overly optimistic with your rate of return. And while these forecasts are made by the brightest minds with the most sophisticated software, they're still not likely to be accurate because predicting the future is impossible, so take everything with a grain of salt. Perhaps, maybe the best takeaway is that if we are expecting lower rates of return going forward, stack the deck in your favor. Save more when you can, because if we really are expecting lower rates of return, that means you have to do a little bit more of the heavy lifting. You have to save more in order to reach your financial goals. What kind of rate of return do you think we're gonna have going forward? Let me know your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I hope you have a great day. Bye. Welcome back to the channel. I don't even know. I was gonna say open money. This isn't that. Welcome back to the channel. This better not be indicative of how this filming is gonna go. Oh, second. Perhaps more economy. Accurate. Schwab says, I don't think Schwab is an easy word to say. Jeez. What's that number? 10%. Let's not do that. And in US Treasury. No! Prior to factoring in inflation. What the heck? Distinction to make. Keep it, it's today? No. But if we're, it's when you're, so they don't, that they have been, why can't I talk today? This is ridiculous. To dig up this, I don't like a 4% estimate. Company mature, very least, if you're comparing a 4%, I don't know which lower, higher this way. Should be, that's weird if I go lower, higher, isn't it? Surge to, now, so your rate of return, let's just breathe.